So, episode 1, my holdings revealed. I'm going to go through my traditional market portfolio with my UK dividend stocks. Started it in September time. A lot's happened. Passing of the Queen, Liz Trust, the bonkers tax thing, the pound going down to parity nearly. And I thought my portfolio would have been smashed into oblivions when I started it. My idea was to put a small amount in, put £1,000 in every single month for a bit, and then just see how it goes, see how it shapes, and then go from there. Now I'm looking to reveal it. Most people, if you're in my Patreon, will know this. You'll see it in the journal. But if you are new on my YouTube channel, welcome. And yeah, this is kind of a monthly update of what I will do. Episode number 1. So if you want to see the videos in the future, obviously check out the new playlist, Building Financial Freedom through dividend investing, essentially. Word on plays, which works. But overall, let's talk about the obvious. What do I hold? Why do I hold it? And obviously, what is actually happening with my portfolio, and also the changes that I've made over the last few months in terms of de-risking from retail sector and yeah, the housing sector essentially, which wasn't too great neither. So in terms of my portfolio, I currently only have 6. You can probably see that in the title, right? I've only got 6, not many. But you can see how much I've purchased. I've put 14,553 in the last few months essentially, and the value is 19,304. I have made some good returns on some of my stocks, which I no longer hold. Halford's been one of them. I think Pets at Home, Taylor Wimpey, a few others did pretty well in terms of capital appreciation. As I say, I was expecting with what happened with the fundamental of the world of the UK, the clown show and the government, I thought my portfolio would have been smashed, but it hasn't, which is good. So, let's explain a few things. So, let me go through the stuff that I have sold. So, I did sell Halford. Halford was just a great grower. Look at the state of it. So, yeah, you can see, like I bought it on the 7th of September and I sold in January. That is a monstrous gain. I am expecting dividends as well in the next few days from this, which would be quite nice. Another one as well was Pets at Home. Not as big of a gain, but still a little gain nonetheless. I wanted to remove some of my exposure from that side of the market. But let's talk about it. So I am mainly in the financial sector. You can see that. Phoenix, Lloyds, Legal & General and Aviva, all financial stuff. So insurances, pensions, all that kind of goody stuff. I do have some exposure to the pharma world and most importantly, mining minerals industry, right? So in terms of Aviva, it's relatively decent, in my opinion. A top UK company, been around for a very, very long period of time, and their dividend yield is pretty good. Realistically, it has a decent little score. In the grand scheme of things, I'm quite happy with the dividend growth as well. It's okay. It's absolutely fine. This is not a bad one. Revenue is a bit random in terms of cash flow on that one, but the data isn't always great on this website, so bear that in mind. But yeah, I just wanted a top quality stock that it's relatively normal to kind of hear about. Another one is obviously GSK. You probably most heard of this randomly. It recently, due to obviously the pandemic and stuff. This is a more recent purchase. I was looking at purchasing it not too long ago, but I waited and I sold some stuff and I've now purchased it. I do think in let's just say a recession, we should be okay, essentially, right? Again, fundamentals of it, not too shabby, but most things do have spikes due to the pandemic. But as you can see, dividend growth on this one isn't as great though. The growth is actually lowering, but this is more for survival because I do think that this one will be okay longer term due to obviously the healthcare sector. Could be interesting, but it's one of those punty ones. Better that than some of the other stuff I was looking at. Legal & General, another one. You've probably heard of it. Let's be honest here. If you've never heard of this, I don't know what... if you're in the UK, you would have a relatively stable, steady stock, as you can see by the chart. Decent dividend yield, not too bad at all. In terms of the analysis of it, relatively good score, not too shabby at all. Dividends sort of stuff, the growth's been pretty good, so it counteracts some of the ones that are not growing. But at the end of the day, this one is a really strong one in my opinion. Not the sort of one that you get massive amount of appreciation, but most importantly, you probably will get quite a lot of growth elsewhere, which is kind of what you want realistically. Let me go on to Phoenix Group. This is one of my newer ones. I've recently just purchased this not too long ago. The reason being is because I wanted to move out of said sectors. Again, relatively stable in terms of underlying growth and stuff like that. Decent yield on the dividend as well. And again, not a bad little score. Essentially, the dividend sort of growth, it's there. It's still a little bit up there. But again, fundamentals, not too shabby neither, even though there is quite a lot of cash flow coming out. But that will probably be investing in other things. But the final bit of the jigsaw, the most obvious, was Rio Tinto. This is an industry-led asset, which is interesting. Mining, exploration of minerals, copper, diamonds, gold, all the sort of stuff that's got a little bit of demand right now. This is doing really well. This is growing pretty nicely. And again, it's not massively volatile in terms of where it's been, but it is growing quite nicely. Again, if we look at the stock analysis, not too bad, relatively average in terms of the dividend score, but dividend growth is pretty huge. This has been doing really, really well recently. And again, if we're looking at the fundamentals, you can see why. Massive amount of money being brought in through this industry. So pretty good pick, pretty happy with it so far. We'll see how it goes. But overall, things are looking pretty good. Now, I invest mainly on trading 212. There's a link below if you want to get involved in the link tree, and you can see this is all my numbers. The reason why it's on privacy is just because I don't want to reveal all my shit in terms of my email addresses and whatnot. But that's my overall account. I do have some free fundage in here. I got some dividends not too long ago. But in terms of how much I get paid, I will explain how that will work in a second. But as you can see, it is all here. You can see all the shares that I've got, so you know that I'm not just flobbing you. But yeah, overall, if we go to my tracker, main portfolio, if we look at dividends, this is what I am expected. So overall, in the course of the year, you can see there's quite a lot of payments coming up. Basically, £1,000 per year. This will pay me over the course of the 12-month period. As it grows, it will obviously increase. Now, the one thing that I have done over the last few weeks is I've increased this yield. This yield was about 6.2% not too long ago. Now it's a lot higher because I have removed Halfords, I have removed Pets at Home, which were low yields, but more of like a retail boom sort of thing. So I've went for more stable in price appreciation, but more passive income because there's a pending recession that could be interesting. I think industry, healthcare, and most importantly the financial sector will probably be okay, because people will be utilizing them to rebalance, and obviously healthcare is relatively normal, and obviously industry as well isn't too bad. But retail sector, housing sector, nah, get rid, no point. So overall, that is essentially how it's looking. It's not looking too bad in terms of what I'm expecting over the next few weeks. As I say, I'm expecting, obviously I got some dividends of Pets at Home recently just sold. Halfords come in, £27 roughly, give or take. But in terms of the dividend side of it, it's quite a lot, and this will grow over time. So in terms of this series, you'll start to see the growth of the portfolio, hopefully fingers crossed, as I dollar cost average into it, as I add more funds into it, as I rebalance my portfolio and hopefully aim to grow it. But as you can see, I've only got 6. That will be increasing over time. I've got a lot of eyes on a lot of things that I'm interested in, which will be pretty good. But yeah, overall, things are looking relatively good. If you want more videos regarding dividends in terms of top ones, different type of ones you can get as well. The main reason why I'm doing my own individual one with a small amount of funds to start off with was because I was in index funds. When you look at index funds and you're getting paid the passive amount and the accumulation, sometimes it's only 1.82%, not enough. This is why I've started this one. Give me a bit more things to manage and ultimately a much bigger yield. I am happy between 7 and 8% yield. I'm pretty happy with that. If it grows even better. For me, where I live, doing this is better than investing in property, which is mad when you think about it. So I will be looking to grow it. Enjoy.